lots of questions that we deal with about what are the characteristics of an IBC account. What makes an IBC account truly different? What sets it apart from other types of places that you can warehouse cash? So I've listed here several different things. Let's start off with tax-deferred growth. These accounts grow tax-free. Tax-deferred is the legal sense that we use, but really if you do this properly, they're never going to be taxed on the growth as it grows every year. It's also not taxed on distribution. So when you start pulling money out of these accounts, if you do that through policy loans or withdrawals to basis and then policy loans, those are not taxed either. So tax benefits all the way around when it comes to this warehouse of cash. Also, you get a competitive rate of return. Our accounts can generate all different kinds of income, especially if you leverage loans and talk with me or somebody, an advisor from my company, I'll tell you more about that. You also have high contribution limits. So there's virtually no limit to what you can put in these accounts. They're limited only by your age and your income. So they're very, very high contribution limits as far as what you can put in. Also, a big advantage to a privatized banking system or an infinite bank account IBC system is collateralization opportunities. These accounts utilize the power, the leverage of collateral. What that means is you won't be spending your own money. You'll be spending the insurance carrier's money. And just to give you an example of that, let's say we give you an example by you building this bucket up, right? This bucket's going to grow at about 3% guaranteed and about 3% or so on top of that, which is a predictable but not guaranteed dividend, for a total of about 6% tax-free. So over here, you have the insurance company's account, the insurance carrier. Well, if you start building up cash in this account, and let's say you build it up to $10,000, it can be $10 million or $1,000, whatever you choose, but you build this account up to, let's say, $10,000, then you want to borrow out $9,000. If this is November and this is December, well, when January rolls around, most accounts would just pay you interest on the remaining $1,000. Why? It's your balance, right? But with this, that's not the case with us. With us, we still pay you interest on the full $10,000. Well, how is that, Scott? How could you pay me interest on money that's not in the account? Well, we couldn't. The money is still in the account. So what happens is the insurance carrier will look to verify that the money is in fact in your account, that you have at least $9,000 in there. Then the company will send you that money, so $9,000 at about 4%. Now this is higher and sometimes lower sometimes, but it's always somewhere around there. So it's about $360 that it would cost you to get that loan, right? Over here, you've got the full $10,000 that's growing at, let's say, 5%. I'm just giving you an example, right? So that's $500. So you've got a growth rate happening of $500. You've got a cost rate of $360. So the difference between those two then is what makes the leverage side of the privatized banking system works. So then what do? You put it right back in. Then you pull out money when you need it, and you put it back in. You pull it out when you need it, and you put it back in. You continue that process for as long as you need it. And the goal is to have this bucket right here be large enough to accommodate all of your needs. In the end, you'll have somewhere between 6 and 12 different accounts. And again, these are all dividend-paying whole life insurance accounts. So you'll have between 6 and 12 of those. Those individually would go right up to the modified endowment contract limit. I've got another teaching video specifically on that, so be sure to check that out. But these will be for different purposes. One may be for vacations. One may be for weddings and funerals. One may be for your house or home improvements. One may be for vehicles or travel. I'll just put cars. You may have one in here just for retirement, right? So whatever the purpose is, you'll end up having several of these. They'll all work the same way. And here's the key. You've got to get to a place where you don't spend your own money going forward. You need to spend somebody else's money. And if you can spend it at this kind of spread, that kind of margin, and even take advantage of potential arbitrage, you're in a great position. Now, here's what I warn people about. There are some people out there that are not authorized practitioners, which means they're not vetted, regulated, trained, and qualified, but they're still talk about doing IBC. They still talk about the infinite banking concept. Well, those people, if they have that kind of conversation with you and they talk about this, What you have to watch out for is to make sure that they don't say, yeah, you can get wealthy just off doing the loans. You can get rich off that. That's not true, okay? They're making this do something beyond what it actually does. Now, should it cover your cost? Yes. May there be a spread on top of that? Of course. So yes, it's a good system, the most efficient system in the market today. So collateral opportunities, this is big. You need to spend somebody else's cash, not your own. Okay. Next is safe harbor provisions. That just means money that goes in this account is safe. You don't have to worry about what's going to happen to it. There are no loss provisions involved. It's also creditor protected, which means whatever you put in that bucket, creditors can't attach. The IRS can't levy that account, so that's a powerful thing. There are also guaranteed loans on these accounts. In other words, you can pull this money out, that's guaranteed. You don't have to apply for it like you do at your bank or the mortgage company or a finance company. They're guaranteed. And the repayments on that are unstructured. Let me tell you what that means. That means you can pay all of it back tomorrow or none of it back ever. It's your choice on how you do this. Now, we recommend that all these accounts be paid back so your collateral is restored. So you can borrow it again when you need it, then build it back up and deplete it as you need it. So, but you decide when you pay that. Maybe you go a year and just pay the interest. Maybe you go a year and don't pay anything. Maybe you pay it all back next week. That's completely up to you. You also have liquidity, which just means you can access this anytime you need it. You've got use of your funds, so these funds can actually be used. It's not like your 401k or IRA where you have to set it and forget it for decades, depending upon your age. And you have control over it. You know, I tell people this all the time. If you don't understand where your money is going, and you don't control where your money is going, if those two things are not true, you should probably find another place to put your money. So these are the IBC characteristics. Are there others? Of course, there's a ton of these, but there is no financial tool, no system, no vehicle in the United States that you can put your money into to warehouse your wealth that has all these characteristics. IBC sets itself apart.